Okay, hello everyone, welcome. Thanks for joining my webinar today. I'm very excited to get this information to you guys. Hopefully, throughout the course of the couple days of this event, you're going to get tons and tons and tons of information. So, really hoping you're getting all the value out of this that you can. Today, I'm going to talk to everybody about how the perpetual wealth strategy and infinite banking and the life insurance that we've been talking about factors in to somebody with more of an entrepreneurial mindset. Okay. Now, if you're not an entrepreneur, that's okay. Don't worry. This isn't for the hardcore risk takers that you kind of typically see or feel when you hear the word entrepreneur. What I want to speak to is anybody that has a way to generate a rate of return that they end up being in control of. Okay, so keep that in mind. I also am going to really be sharing a couple ways of how we can utilize the perpetual wealth strategy and the insurance and our cash values to help us generate that income as entrepreneurs. Okay, again, don't feel like you got to be a huge risk taker, because myself in my life, I'm going to introduce myself here now. My name is Brad Gibb, and I've been in this business for 5 or 6 years now, but I've been living this for more than a decade. Okay, now I've put here that I'm an entrepreneur, which hopefully qualifies me to speak to all of you today, because I have owned and operated many businesses. I am a wealth strategist here at Paradigm Life. I also teach and mentor in real estate education, helping people create cash flow through a company, Atlas Wealth. I've started in my prior days, I was an accountant and I had a consulting firm where we took companies public. So I've been through this entrepreneurial process over and over. But one thing I want to stress is I don't really consider myself a big risk taker. Okay, so if you've kind of see or have wanted to learn to generate income but haven't felt like you're a risk taker, take a deep breath. That's okay. Hopefully, you're going to get a couple things out of here, out of the presentation today. I also put on here that I'm an investor. I do actively invest and work to do that on a regular basis. So my investment of choice is real estate. So I do a lot of single family homes. I'm also invested in some larger commercial properties and some syndicated deals, have done some lending on multi-million dollar properties. So I do consider myself an investor. I'm an author. I've written some ebooks and published a lot of information, and that's hopefully been beneficial. And then last and really probably most important, I view myself as a husband and a father. I have 5 beautiful children. That's really kind of the drive and the motivation for me. So anyway, that's just a little bit about me. Now let's get to the topic at hand here. Okay, I want to introduce this person. This person's name is Mark Ford. He is a mentor of mine. I have followed his stuff, and I've had lots of opportunity to sit down and chat with him and be mentored by him. But I want to get a couple ideas out that I learned from him. Okay, he is an entrepreneur himself, publisher, real estate investor. He is part of one of the largest financial publishing businesses on the face of the planet. He's worth many tens of millions of dollars, if not hundreds of millions of dollars. And he says this about his own industry, okay, the investment advisory industry, and by that I include brokerages, private bankers, insurance agents, as well as investment newspaper, magazine, letters, and internet publications, is a huge multi-billion-dollar business based on hard work, clever thinking, and sophisticated algorithms, but also on one teensy-weensy lie. And this is a lie that we talk a lot about at Paradigm, that I talk a lot about at Atlas, and as well as I think all of you have felt, which is why you're here, which is why you became a client. That teensy-weensy lie is that you can grow wealthy through investing in stocks and bonds. Now, this is from somebody who is part of a major publication that teaches almost exclusively on stocks and bonds, okay? So this is kind of from the inside saying that we need to be wary and we need to understand. This is what he goes on to say. So that brings up the question, if we can't get wealthy through stocks and bonds, what do we need to do? Okay, where do the wealthy invest and what do they do? Okay, Mark Ford says this. He says their primary focus is on increasing their active income. Usually this comes from a business they know inside and out. They invest in real estate and other outside Wall Street opportunities. And I want to focus on that idea that they focus almost exclusively on increasing their passive income. Their mentality goes something like this: if they want more money, or if they want a better lifestyle, or if they want more security, they don't look to find someone else to give their money to. Okay, let me say that again. The wealthy do not first look to someone else to make them wealthy. They look internal. And this is the opposite of what Wall Street would have us believe. This is the opposite of what internet publication companies would have us believe. They would have us believe that we're too dumb, or that the world is too risky or too complicated for us to understand, and we should give our money to somebody else who can turn that into more money. Okay, but this runs contrary to the belief that I hope everybody has heard at least sometime, and even more, I hope they believe it about themselves, that the single best investment you can make is where? That's right, in yourself. Okay, so this is a big sort of yin and yang, or really kind of contrary thought that I still struggle with, but I certainly struggled with a lot early on. Anytime I think about investing, I'm always told to give my money to somebody else rather than build it myself or invest it myself. Okay. But that is exactly what the wealthy do. Okay. And this is why I just want to kind of back up here and make a point of why the wealthy, and why you ultimately are going to have to be in charge of how your wealth is created, at least to some degree. Okay, this is a chart put together by a gentleman named Wade Pfau. If you listen to anything that we've done in the past, we've mentioned him before. And he did a study based on the average rate of return that an investor can get. This is more traditional methods. He wasn't as interested in retirement planning from the standpoint of what are safe distribution rates, or how much income can you take from your asset base. He feels that the amount of income you can take from your asset base is fairly fixed. And since we've got that fixed result, he looked at the inputs and said, how much do we have to put into our investing in order for it to produce the results that we want? And so here, if we want to replace, as this says here, if we want to replace 100% of our final salary, okay, when we retire, that means if you're making $150,000 today and you want to retire tomorrow and you want to be able to have 100% replacement of that, the input required is this. And we'll go right to the middle of the table. Let's say you've got 30 years to work and you want to live in retirement for 30 years, okay? That means that you have to set aside, if you're going to follow the traditional model of saving, you have to set aside 33% of your income. How many out there, raise your hands, are saving 33% of your income? Yeah, not very many of us, right? Okay. What if you want to, lifespans are increasing. Who out there would like to take an early retirement? Let's say now work to 65 and maybe work to 55. What if we wanted to live for 40 years? Okay. 37% of our income. What if you're getting a little bit of a late start and you're, say, 40, 45, or 50, and you don't feel like you have really a lot built up? Look at this. What a difference 10 years makes, huh? You're going to have to save 71% of your income. Okay, good luck. Good luck with that. Even the more fortunate of us that maybe have started early on. Okay, I got started investing when I was in my mid-20s, so I did have 40 years technically to accumulate. Man, 17%, 18%, 15%, that's still more than the average person, okay? So this is why we can't save our way. And this is kind of, don't tell too many people this, but this includes life insurance. Okay, if your plan is to strictly fund a life insurance policy, it's going to do better than the market, no question. But saving our way to retirement comes with problems, because the input side of it, to be able to replace it after we've got things that are eating away at our wealth, mainly inflation, becomes a very difficult challenge. Okay, we need more than just a savings vehicle to do this. Okay, so this is what I want to put out there. Okay, a lot of people that were getting traditional financial advice, I call this the what's that called? An iceberg. There we go. I call this the iceberg principle, okay? When people want to say, how do I make more money? How do I become wealthy? Logically, we would look to the wealthy, right? But that's a lot like looking at an iceberg and analyzing it by what's floating above the water. We get to see everything the wealthy have accomplished and where they've now put their money after they created it. Okay, there's lots of studies out there about the Yale Endowment Fund or the Harvard Endowment Fund or the top 10 billionaires in the world. Where's all their money going? Well, but I'm not an endowment fund. You have very different goals than an endowment fund would have, right? So it's not very helpful to model what we're doing after what the rich are already doing. Okay, a little story around this. A neighbor of mine is a wealth advisor, and we chat from time to time, and he's always trying to convince me to let him manage a little bit of my money. Okay, he doesn't really know what I do, so he doesn't know how silly that request might be from me. But the way he tries to convince me, bless his heart, is he drops names of very wealthy people in the area that he manages their money to. Okay, and he says, well, so and so, I've been doing XYZ for him, and this other person, I got him into this really cool thing over here. And so he tries to impress me with that and woo me into saying, okay, if you're so smart and you've convinced them to, well, then I better do it also. Okay, but a little while ago, and actually since then, we haven't really had our normal conversations around wealth. I did ask him, I said, okay, I'm interested in you managing my money. And he got excited. And I said, on one condition. He says, okay, what's that? I said, the condition that you can manage my money under is not that you do with my money what your wealthy clients are doing with it. He started to get kind of a confused look on his face, and I said, you can manage my money if you can tell me and do for me exactly what those people did to make their money in the first place. Okay, and he just sort of had a confused look, and the conversation pretty well ended. Okay, and that's because money managers don't help create wealth. They take wealth that has already been created and they try to perpetuate it or grow it or move it forward. But never, I would posit, never have money managers actually created somebody to help them become financially independent. It's after somebody is financially independent, then we've got all of this. So what we need to do is we need to take a good look below the surface and figure out what it is that really helped people to create the wealth in the first place. Okay, and this is what led me to a very different path. Okay, this is what has a lot of the education that I teach is really centered around this idea. A lot of people sort of get confused and scratch their head when I say I'm in the wealth, advisory industry, and they ask me about the markets, and I say I have really no idea what the markets are doing. They ask what's going to happen now to the stock market now that Trump's president. I say I don't really know. They say, I thought you were in money and finance and investing. I'm like, yeah, I am, but I'm in helping people become financially independent, and it just doesn't have anything to do with the market. So I hope that made sense. What I want to talk about is we want to talk about what the wealthy did to get rich in the first place. I have no interest in what they're doing now. That's not applicable at all. Okay. All right. Hope that makes sense. I didn't belabor that too much. So if that is the case, it's nice to know that, but then, all right, where do we invest? Okay. And what I'm going to cover today is that we're going to talk about 3 areas of where we should invest, the best investments that we can make. Okay, now you're all clients, and so hopefully you all have an infinite banking or a perpetual wealth strategy policy in place already. So we're going to continue doing that, right? That's the foundation that we're going to build from. But with that cash value, where should we invest if we indeed cannot save our way to retirement, which is what I talked about earlier? We can't do that. So where should we take and what should we focus on? Okay. Here's a little quote by Bobby Jones. I'm not a golfer, so I don't know who Bobby Jones is, but I like the quote. Okay. He said, competitive golf is played mainly on a 5.5-inch course, the space between your ears. Okay. It's a mental game, right? And this could probably apply to basketball or football or just about anything that we do. And I'm going to say that this also applies to building wealth. Building wealth is mostly a function of what goes on in the 5.5 or 6 inches between your ears. Okay? It has everything to do with that, and really only that. Okay? So for me, the number one place that I could tell somebody to invest to get rich is in their own education. Okay? My friend Mike Isom teaches this fantastically well. I'm not going to go into all of his detail, but he talks about your number one asset, your number one investment, and your number one strategy. And it's very detailed around this concept of investing in your education is the most important thing you can do. Now, education, let's clarify that, right? There's lots of things that could technically qualify as education. Okay, now I spent 6 years basically studying money. Okay, I have a degree in economics, I have an undergrad in accounting, a master's degree in accounting, as well as minors in statistics and economics. I also was only a few credits short of getting an MBA at the school I went to because I just put all my electives onto the MBA side, but since I wasn't officially enrolled, they weren't going to give me a degree. So anyway, I spent 6 years studying money. And then I started to actually get educated. Okay? It wasn't until I left the ivory tower world of my higher education that I started to understand how the real world works. Okay? And the way a business operates its money and cash flow is very different from how an individual is going to do it. Okay? It's a difference between the macro view of things and the micro view of things. Too much of the information today out there is macro oriented, meaning it's a conglomeration of a lot of the very big picture, very high level, but you are a personal economy. You are an economy of one, and you've got to make yours work. Okay? So a couple examples of what I did to invest in my education that ended up ultimately being the best thing I ever did is this. When I was working as an accountant before I started my consulting firm, so this was back in, 2008-ish time period. And at that time, derivatives were obviously a hot topic, okay, in the accounting world. And we worked with public companies, and a lot of these companies had derivatives on their books. And so at the firm I was at, nobody in our firm was an expert in derivatives, and we had some opportunity to acquire some clients in that field. So I took it upon myself to take my vacation days. Okay, this is how boring I was. My wife laughs at me, but I took vacation days to go to a conference to learn about derivative accounting. And I was excited to do it, believe it or not. Okay. And I don't remember what the course was, $1,000, $1,500, $2,500, something like that. But I actually paid for it out of pocket because my firm was very, very small and they weren't big into investing in their employees, which is ultimately why I started my own firm. But I did it out of pocket. I did it myself. And then I came back and I said, great, I now know how to do accounting that nobody else in our firm knows how to do. And I'm going to go acquire clients. And then I negotiated a cut of those contracts. I negotiated basically a commission off of anybody that I could bring in based on my knowledge to do dividends. And in the year that I did that, I increased my income by more than $10,000 that year. Okay, pretty good return on my investment, would you say? 10 times my money? It's not bad, okay? And that eventually I actually parlayed that information and the reputation I built in that niche that we had created, that I was the go-to derivatives guy. And I built an entire accounting practice based off of that. Okay, so it was an investment in my ability to generate and earn income that paid off immensely. Okay, so in your life, you can look at ways that you can make investments, whether it be in your current profession, okay, or whether it be in a side profession. We're going to get to that in just a minute. Okay, here's another example of how I invested in my education. And it really was the best investment I could make. If you thought I was boring before, you're going to think I'm even more boring. So when I wasn't actively trying to increase my income and I did have time off, I would also go listen to economics lectures, like literally professors talking about economics. Okay, not even like applicable to the economy right now, just general economic theory. This is wow, I look back at this as boring. Okay, I kind of still do that. We actually, I don't know if you've ever had house guests over and kind of played. This is a clean version, but like a dirty secrets game, right? Like, so who, which guys are watching The Bachelorette or something like what's your guilty pleasure? And we were doing that once at a white elephant party at my house. And when it got to me, my guilty pleasure was I like to listen to economics lectures in my car on my drive to work. And everybody was like, game over, you win. Who can beat that? That's the most lame, boring, nerdy thing I've ever heard in my life. But anyway, I did that and I liked it. And through that, I met a gentleman named Patrick Donahoe. Okay, and we connected. Okay, I mean, it was around about lots of things, but I was listening to economics and finance and personal development, and it was at a conference where we went to listen to Bob Murphy speak that we really connected, and then it began this alignment of me leaving and joining Paradigm Life as a wealth advisor, and then building a real estate education company, and all of the stuff that I've done now because I invested in my education. I didn't listen to. I mean, I never listen to really music in my car, things like that. It's always audiobooks. It's always personal development. It's always investing back in myself. This next year, I just went through a lot of, it's December now, and I do a lot of goal setting at this period of time, like a lot of people do. And I'm lined up this year to write checks totaling in the mid five figures for personal development courses and reinvesting in my own education, whether it be mastermind groups, whether it be advanced trainings. One of them is just a personal motivation. I'm going to go out and someone's going to beat me up for a week and kind of put me through some torture test type stuff so anyway, I live this continually. There's never a point in time where there's nothing left to invest in yourself. And for me personally, that's the first place I look to invest. I look around and I try to assess my shortcomings, my weaknesses, the gaps in my knowledge, and the more effectively I can fill those, the more income I'm going to generate, the better of an investor I'm going to be, the less risk I'm going to take because I have the knowledge. So in short, it's the best place that we can start. So if you've not invested in yourself, I challenge you for this coming year to do that. Find a course. Find whatever it would be, a book, and I would actually suggest a retreat. Find a 3-day or a 2-day event where you can go unplug from your life, take your spouse, leave your kids at home, and do something. One very, very, very good one is the Real Estate Guys. If you look up the realestateguysradio.com, they do a goals seminar in January that is phenomenal. That's a place that you could start, and don't look at the price tag as, oh man, that's expensive. Look at it as I'm going to make an investment in myself, and this is going to generate a return. And it may come in a strategy you learn there. It may come through a relationship that you make. It may come through an idea that you bring back and you implement. Whatever it looks like, you will get a return on it, and it will be the best return you can make. Okay, so that's piece number one. Piece number two is this guy. I don't know if you know him. He's Gary V. He's all over Facebook. He's got videos. He's up on stage yelling and screaming and swearing, and he's talking about this idea of hustle. Okay, now he is sort of the father of hustle right now, and he talks about success is a lot based on how well can we hustle. Now, for our application today, I want to say, do you have a side hustle? Okay, and in today's world, this is easier than ever. So again, if we've checked the box of you've invested in yourself, the next place that you could invest is to, again, rather than find someone else to give your money to that's going to grow it, we can look at this and say, how can I generate more income? How can I create something? And in today's world, this is easier and easier and easier. Okay. And with this, what I want to emphasize here, if you kind of feel like you're not on track for your goals, this can help in one of two really big ways. Okay. First off, if you find yourself in a situation where you don't feel like you save enough, don't save enough. Okay, it's expensive to live today. We've got taxes and mortgage payments and rents, and kids are expensive. Believe me, I got 5 of them I know. So if you're in a situation where you can't increase your income at work, okay, you're just sort of your earnings capacity in the 40 or 50 hours you spend working every week is fairly fixed. You're going to be limited in how much you can save. Okay, you could cut back here or there, but ultimately we're going to find a limitation. It costs a certain amount to live today. So if you don't save enough, but if you could generate a side hustle to put $200, $300, $500 in your pocket every month, how would that change your ability to create and generate wealth? All of that would be found money that could be put toward achieving your financial objectives. Okay, this can be done any number of ways, but if you're in the camp of you don't feel like you save enough, don't compare the side hustle income to replacing your active income. That's not the point. Okay, especially if you don't feel like you're a risk taker. Keep your day-to-day job, but figure out a way to side hustle here or there. This could be teaching piano lessons, cutting hair, being a yoga instructor, whatever it might be. And in today's world, there's lots you can do online. Okay, it's easier than you might ever have imagined. Okay, there are Amazon businesses all over. Okay, and you might need to pay for a course to learn something to do that. Another really interesting one, if you're interested in looking some things up, is there's a guy named Russell Brunson at ClickFunnels that teaches about how to make money online and has a platform and lots of education around that. So there are ways to get out and do this. I'll share a little story about a client of mine, and this is seriously one of the most inspiring stories to me, and I've told him this over and over. But when he came to me, he was getting divorced. He's young, he's in his 30s, but was getting divorced. And when he met me, he was in debt and was a manager at a Walmart. So he's making, I think, maybe 30, 35 grand a year, had at least that much in debt and really wasn't saving anything. Okay, but he had the desire. He wanted to get something figured out. And he was in this camp of he doesn't save enough. So as we talked, I showed him some ways he could restructure his debt. We created a couple $100 a month in cash flow, and that set him on fire. Okay, really what set him on fire was he had a credit card debt at 18%, and he had a motorcycle he owned that was free and clear, but it was worth $4,000 or $5,000. And what we did is we went and got a title loan on the motorcycle, paid off the credit card debt, and it freed up $200 a month. And he'd never thought creatively about how to structure things, and it lit him on fire. And we had lots of conversations around this idea of side hustle because he needed to pay his bills. He had to keep working, but he needed more. So he signed up for Uber. And on the nights and weekends when he had some time, he started driving Uber. And then after a short while, he found some niches within the Uber market. I don't know all the details, but he very shortly actually ended up replacing his entire income. Now he's still working his Walmart job, but then he was doing Uber on the side. And that his Walmart job obviously wouldn't last long in that case, but then he got a couple of Uber cars underneath him. Okay, and then the next thought he had was he went to Airbnb. And in the house he was living at, everybody was renting rooms. His landlord was sick of it, so he went to his landlord and negotiated a contract to where she allowed him to manage, basically bought the property for him with no money down, and then was in charge of renting this out through Airbnb. And he doubled his income again doing that. Okay, so and this was a case of his side hustle turning into well over $100,000 a year in income, but it started from just identifying an asset that he had, a car. He had some time on his hands, and he was willing to give it a shot. And he didn't need to make a lot. For him, it turned into a lot. But what if you could put, like I said, $500 a month into your pocket? How fast would that accelerate your ability to create wealth? Okay. Now the second part is what if you are nearing retirement, but you don't feel you have enough? don't have enough saved. Okay, this might be you. Okay, how does a side hustle apply to you? Well, $500 a month isn't going to do a lot. Okay, if you're going to try to retire, I mean, it might. Okay, but as far as growing wealth, that's going to take a long time to take that money, then find an investment and create cash flow and do everything we need to do for retirement. Okay, so your side hustle is going to have we want to analyze this and think about this a little bit differently. Okay, again, when you retire, you don't have to stop working. Okay, you could retire from your current employment if you wanted to, but that doesn't mean you can never work or earn money ever again. Okay, I encourage my father-in-law all of the time. We talk about this. He's getting to this stage where he's going to want to retire, but he's not the kind of person to sit back in a lawn chair and drink margaritas all day. He wants to be out, and one of his passions is cars. He loves cars, and he's very, very good with people. My suggestion to him is, hey, go get a job on, there are a couple exotic car dealerships around. Go get a job selling BMWs or Lamborghinis or Maseratis or something you're passionate about. You'd be around something you like. You wouldn't have the pressure of needing to do it to feed your family. So there wouldn't be, he would never be a car salesman to feed his family, but he doesn't need to at this point. He just needs to supplement. So he could be doing something he loves and enjoys without the pressure of needing to have it be a career. And it could be something he could really, really enjoy. And here's the way to think about it. If you were able to generate $1,000 a month doing something like that, okay? And I've got a couple other stories I'll share. That's $12,000 per year. It doesn't sound like a lot, but when we compare it against kind of traditional retirement planning, again, if you had assets that you could safely take 3% per year from, and just throwing a number out there, that's the equivalent of having $400,000 in an investment. If you're thinking traditional finance, 3% is about the amount of income you can rely on from a mutual fund or an IRA or 401k. It's like having $400,000. Does that put into perspective the value of a side hustle if you are looking to retire and continuing to work? For every $1,000 you can create $1,000 a month. Okay, $12,000 is not very much, but when we look at the actual value of that, it's like having $400,000 in the bank. You got twice, you're almost a millionaire. Okay, because wealth is not about accumulated value. Wealth is about cash flow. And you as a person have way more. I mean, if you can generate $2,000 a month, you're worth 800 grand. You can create that asset very quickly. Look to invest and find opportunities for yourself. Another example, I had a client that lives in the Seattle area by Puget Sound, and his goal was to retire with a boat and sail as much as he could. Every day he wanted to be on the water sailing, but he was in this boat of not having enough saved. So we had discussions around this, and what we ended up deciding and sort of compromising on was he was going to sail 4 days a week, and then he was going to instruct sailing 2 days a week. He was going to use his boat that he already had that he didn't feel like he could keep if he was going to retire. We turned to that asset that he was going to have to sell and liquidate in order to finance his retirement. Instead, we thought about it like a side hustle. And so, are you willing to teach sailing for 2 days a week in order to sail yourself 4 days a week? It seemed like a pretty worthwhile trade. Okay, and then the other benefit we get of that is he didn't have to draw down his other assets, let them continue in compounding. I mean, the ripple effect of creating income here is significant. So you could find a passion of yours. Back to my father-in-law, the other thing we've discussed time and time again is he's got a lustrous career in law and government work. And any university would love to have him as a guest lecturer or a night teacher. Okay, now right now, while you're working full-time in your busy family, that doesn't make a lot of sense. But for him, when he's retired, if all he had to do was teach a college course on something he knows like the back of his hand and loves and enjoys, poured his entire career into, and teach that 2 nights a week and make $1,000, $2,000, $3,000 a month, it's not a bad option. Okay, so that's another thing to consider with where you could invest is, rather than trying to give your money to somebody else, create for yourself this opportunity. Like I said, to rewind, whether you are in the category of you don't save enough, maybe an investment in something that allows you to create that income would be worthwhile. Or if you don't have enough saved, find a passion or a hobby or learn a new skill that can be monetized. Okay, so side hustle. So first was invest in your own education. Second was look to create some income with a side hustle. Okay? And it doesn't have to replace your income. Okay, it can supplement or add to it. All right, last piece here is, what if you already are an entrepreneur and you have an existing business? This is one of the big challenges of probably one of the most difficult people to help understand the perpetual wealth strategy or infinite banking here is somebody who looks at their business and says, if I have $1 and I invest in my business, I get a 50, 60, 80, 90, 100% return when I grow my business. But if I put in life insurance, I get 5%. Why is that exciting, right? Or they even look at real estate and they say, yeah, that's great and all, but look what I can create in the here and now with my business. And I do not disagree with them, okay? After your education, okay, if you are in the case of having a business, the best place you can put that money is back into the business. That's what Mark Ford said. It's what I firmly believe. I experienced that. The greatest gains in my wealth came from the businesses that I own and operate. Okay, so now we've got this dilemma. Again, this isn't just a dilemma for business owners. It does apply to, let's say you're a real estate investor. You can get better returns in real estate than you can get in the policy. I can get better returns in lots of other investments than I can get in my policy. So it brings up this question of, where do I invest if I have these kinds of opportunities? Okay, and this is the way I like to think about it. Okay, you need to understand the difference of ROI, return on investment, versus ROW, or the return on your wealth. Okay, this is a discussion. You've probably heard this at least to some extent as you became a client here, that there's a difference between the micro view of return on wealth and return on investment. Let me say that again. The micro view of return on investment versus the macro view of your return on your wealth. Okay, let me show it this way. Let's say, and I'm just going to use big numbers so the math is easy. Let's say you have $1 million of investable capital. Okay, or just $1 million net worth. $1 million net worth. Would it make sense for you to take all $1 million and invest it, regardless of where it might be, whether it be back in your business, whether it be into real estate, whether it be anywhere? Would you ever want to deploy all $1 million and have it out there? Okay, if you're saying yes, well, that's wrong. Sorry. No. The answer is no, and you probably know this, okay? So if you said yes, it was probably because I didn't phrase this well enough. Out of the $1 million, we would for sure want to partition some of that and keep it out as liquidity. Okay, whether it be your rainy day fund, whether it be your dry powder or an opportunity fund, whatever that looks like, we've got to keep some money liquid always. Okay, so just because we have $1 million doesn't mean we can invest $1 million. Okay, so let's say for the case of this discussion, let's say 20% of your money cannot be invested at any given time. Okay, and then our investments are the other 80%. Okay, so in this case, that's $800,000 or $200,000. Okay, and let's say that this $800,000, again, we're just going to keep the numbers simple. Let's say you can invest that at 10%. Okay, so if your investments generate 10%, then you are earning $80,000 per year. Okay, your wealth is growing by $80,000 a year. Okay, so a lot of people mistakenly look at the return they get on their investments and expand that to the total return on their wealth, and it's it's incorrect. Let's take a look at this. If you've got on the 80,000, or sorry, on the 800,000, the $80,000 return is indeed a 10% return on investment. But when we look at this person's entire net worth of $1 million, they are only generating an 8% return. Okay, $80,000 divided by a million. Now that may not sound like a big difference, okay? But if we were, again, expecting a 10% rate of return and we only got an 8% rate of return, that is a 20% difference. Okay, so our investments are very, very different. And the goal with the perpetual wealth strategy is to make what the wealth creation that we're already involved in better. And here's how that works if you haven't seen this before. I'm going to keep this up here. If we could take this $200,000, because most people, where do they keep their liquidity? In a bank account, earning a whopping 0%. If you're earning anything, it's a rounding error difference from zero. Okay, so we're going to assume you earn 0. Okay, but what if we could take that 0 and turn it into, let's just use 5%. 5% of 200,000 is $10,000. Okay, so we just took our total return up from $80,000 to $90,000. So our wealth is now increased by 90 instead of 80. What is that in a rate of return? That is a 9% rate of return. Okay. Now again, going from 8 to 9 doesn't sound like all that much of a difference, but that is a 12.5% increase in efficiency. This means your wealth is growing 12.5% faster than if we didn't have something like the perpetual wealth strategy or infinite banking. Okay, I hope the magnitude of that hits home. 12.5% more efficient. And it actually, as we compound this over time, this actually turns into about 20% more wealth. Let me show it to you this way. Okay. If we have 30 years to invest and we are getting 8%, and let's say, again, we have $1 million, we would have $10 million at the end of this point in time. Okay, right down here. Okay. But if we earned 9% instead, that's now 13.2 million. Okay, so 13,267 versus the 8%. Oh, look at that. Over 30 years, it's actually, your wealth is 30% greater because we're compounding that 12% efficiency over 30 years. Okay, a 1% difference in our overall return on wealth is quite impactful. Okay, and this is something that business owners and real estate investors in particular face every day. They have to keep capital liquid. With real estate, you've got to save up a significant amount of capital to be able to buy the next property. You've got to keep money on hand for repairs, for vacancy, for maintenance, right? And every month you collect $300, $500, $1,000 in cash flow that has to sit somewhere until it can be reinvested. Okay. With business, it's the same thing. It's about sitting liquid so that we can take advantage of opportunities, whether we have to buy inventory from time to time, whether we have to buy new capital equipment, whatever that looks like, we've got that money that has to be sitting liquid. Okay, the challenge for most people who don't have perpetual wealth is they feel like their only alternative is put it into a 401k or an IRA or a Roth. Okay, but when they do that, they're conceding that they are not good enough to find a way to invest it, and instead they should give it to someone else's company to grow. If I buy GM stock or if I buy a mutual fund, I'm investing in someone else's company, not my own. Okay. But this gives us the ability to put that capital to work, yet keep it safe and available for the business that's going to generate the most amount of return for you. That's nothing to say about how much more efficient we can make this 8%. Okay, that's That's a topic for a different webinar, how we can take the investments we are making and run them through the banking concept and make them even more efficient. But just that money that has to be there and has to be idle can improve your personal economy by 12.5% and give you 30% more money at the end of the day. Okay. So to just quickly wrap up, I want to thank you for attending. Thank you for listening to my rambling and my rant here. But I hope that this has been an impactful discussion for you, and hopefully it's opened your eyes. This topic is a difficult one. I'm a very formulaic type person, and I want step by step. Do A, then B, you'll get C. But this is a topic because it's so individual and so personal, and there's so many different directions this could go. I can't give you a formula, okay, of how you can increase your active income or how you can make these three investments. All I can do is hopefully share stories of my own, stories of my clients, and use examples for something to jog inside of your own mind or to see some opportunity that you didn't see before and be able to take advantage of it. So I really hope that that's what happened today. Think about it this way. If you're looking to buy a new car, okay, when I bought my truck, as soon as I bought it, all of a sudden, or as soon as I was looking into it and researching it as to whether I wanted to buy it, all of a sudden, I saw that truck everywhere, right? I thought I'd never seen one before. I was going to be the only person with it. And then all of a sudden, ooh, there's one. Oh my gosh, there's another one, right? So whatever we focus on, our mind sees. What we're not focused on, even if it's there in front of us, if we're not looking for it, our mind lets it blend into the background. So I want to emphasize with that, hopefully this sparked something, even if you can't do one of the examples I shared, hopefully it can change what you're focused on in your wealth building, and you will see opportunities that are already staring you in the face. I guarantee there's an opportunity for you to invest in your own education, to invest in a side hustle, or to reinvest and change how your business capital is being operated and have an impact. So my challenge and the close for this is to take the time to look and find those opportunities, okay? Because like I said, they're there if you start focusing on them. So again, thank you for joining. I hope you're getting a ton of value, not only out of my presentation, but all of the presentations here. And with that, I wish everyone all the best to your continued success. And again, thank you for attending.